Aerospace and defense ETF soaring? For a bold trade in this sector, trade DFEN, Direction's Daily Aerospace and Defense Bull 3X shares. Don't miss your next big trade. Direction Leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foresight Fund Services, LLC.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Coming up on today's program, diffusing single stock risk. We're going to tell you how to do that. Also coming up on today's show, we're going to give you a quick recap of where we are, where we stand in terms of global market benchmarks, so that you can understand how your own investments should be performing. 844-305-7800 is the number. We're here if you want to talk about anything related to your retirement portfolio. Maybe you want to talk about a particular stock, mutual fund, ETF. We can do that. We even talk cryptos, if that's what you want to talk about. Again, 844-305-7800. You can also follow us and tweet us 24/7 as well as live. Live includes 24/7 at Index Show. That's where you find me on Twitter. So taking a look at market action this past week, we saw the Standard & Poor's 500 declining by 1%. Starting the month of October and fourth quarter, yes, it is the fourth quarter on a week note. Historically, Octobers have been quite volatile. If we go back, stretch back to the history of the stock market, pretty expected. Nothing really shocking about this particular move. We are seeing a tick up in stock market volatility. That's okay. That's normal. Volatility has been quite muted throughout the year. We did have a little bit of a pop earlier in the year, like January or February, but since then it's been really calm, quiet waters. And so we're starting to get back to a little bit of a normalization in terms of stock market volatility. Now, in terms of broader market performance, if we take a look at the bigger picture, the total U.S. stock market since the start of the year is ahead by just over 9%. Ticker symbol SCHB, that's the Schwab U.S. Broad Market ETF. That tracks that area. So we're talking about the total market, not just large company stocks. S&P 500, of course, is just that, large company stocks. It does not include mid caps and small caps. So when we take a look at the broader market, very strong performance, and even stronger relative to international and developing markets, which have been in a funk for most of 2018. Developed international stocks, VEA, down about almost 4%. Emerging markets also struggling. VWO down almost 13% since the start of the year. So that's how U.S. stocks are doing relative to the rest of the world. Very good. In terms of other major asset classes, bonds, ticker symbol BND, that's the total U.S. bond market, down about 2.5%. Global real estate down about 2%, REET. And then one final area, commodities, ticker symbol USCI, ahead by almost 0.75%. We're seeing a little bit of a pop lately in energy prices, especially crude oil, and that's lifting commodities. So that's your big picture view. Look, see, and compare the performance of your own investments versus some of these major benchmarks. What I find consistently, and I know this because of the report cards, the portfolio report cards that I've done and continue to do, what I find from my examination of market performance is that the vast majority of investors, sadly, consistently underperform index ETFs. And we can look at it asset class by asset class. It's not just limited to index stock ETFs, but it's also index bond ETFs, index commodity ETFs, index real estate ETFs. You take any actively managed fund in whatever asset class, real estate, commodities, emerging markets, U.S. equities, whatever, currencies, and match that up with an index ETF that does the same thing, and you're going to see, in most instances, underperformance by that active manager. And so this is why we teach you on this program that the foundation of your portfolio, the foundation of your strategy should be built on low-cost, broadly diversified index ETFs that serve as proxies for the asset classes they're tracking. So that's what we're teaching on the program. It's also what I teach in my online classes, and the fall classes are open for registration. Feel free to join. Just go to indexshow.com and enroll. 844-305-7800 is the number. We're going to talk about diffusing single stock risk. We're going to have some context for you on today's program of where investing in individual stocks, where that belongs inside your investment portfolio, if you're going to do that. Okay? So we just told you that the core or the foundation of your portfolio should be index ETFs, right? That's the core. That's the foundation. Well, what do I mean by that? Well, that means it's the majority of your portfolio. So what am I saying? I'm saying at least 51% or more of your portfolio should be earmarked for your core or your foundation. And again, that's index ETFs, right? Because if it's anything less, think about this. If the foundation of your portfolio core is anything less than 51%, it all of a sudden isn't the foundation. It's not the core. It's the minority. And that's not the way you build a structure that's architecturally sound in the real world, in the investment world, or in any world for that matter. You have to have a foundation that's strong, that's solid, that's well-footed, that can be a source of shelter for you, also be a source of growth. But when the hurricane strikes, when the tornado strikes, when the winds become unfriendly, you're going to see that the portfolio's built on a strong foundation. Those are the ones that survive the storm and that endure. Meanwhile, the portfolios that were incorrectly built with a weak foundation or weak core, not built on index ETFs, typically those are the ones that are first to self-destruct, self-implode, and be wiped out. So we want you to understand these things before the hurricane. Yes, there will be a hurricane in the future. Right now, market conditions here in the U.S. have been quite friendly. But we know that will change. We don't know the exact date and hour, but we know it's inevitable. We know it's guaranteed because that's the way financial markets work. They don't just go up, up, up. They go up and they go down. And by the way, that's quite healthy and quite normal for markets to go up and down. In fact, when they go down, it provides the prudent investor, the keen investor, the observatory investor, an opportunity to acquire assets, great assets, at lower prices. But most folks don't do it that way, do they? They run for the hills. And so this is what we want to teach on the program. This is why we exist. This is our investment philosophy. We make it your philosophy. 844-305-7800 is the number. Build your portfolio on a solid core. We're going to talk about how to diffuse single stock risk. Now, for the record, I am not against investing in single stocks or individual stocks at all. In fact, that's quite fine. In fact, you may be able to outperform an index by a quite wide margin. But where should you be owning individual stocks? And what is the proper context for investing in individual stocks? How do you diffuse the risk? How do you avoid blowing yourself up? And many people have. They've stabbed themselves all over with many pains because they don't follow some basic premises and rules to stay out of trouble. I'm going to give you what those rules are on today's show. I'm Ron DeLegge. This is the Index Investing Show. Stay with us. I'll be right back.
The Index Investing Show with Ron DeLegge.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
All right, welcome back from the break. This is the Index Investing Show. We're here. If you want to talk about anything financial on your mind, a particular stock, mutual fund, ETF, 844-305-7800. Those of you that want more research on exchange-traded funds, got a couple of things that I want to share with you. First of all, ETF Guide Premium, which I oversee, has a tactical ETF trades that go inside your non-core portfolio. Go long, go short, use leverage, as well as overweight or underweight specific segments of the market. They could be industry sectors. ETFguide.com Premium. And then also at that same site, I offer quarterly reports that are complimentary at ETFguide.com that segment the various ETF markets by where they focus their investments on. So, for example, I've got a great piece for commodity-focused investors. The fourth quarter piece will be coming out shortly. But we've got that. We've also got a long-short leveraged guide for ETFs, and it neatly categorizes all of the exchange-traded products by not just the asset class or area where they are investing, but also by the leverage point, whether that's 100%, 200%, 300% daily leverage. Some funds even use, or products use 400% daily leverage. Isn't that crazy? So, and then, of course, there's funds on the leverage side that are bullish, and then there's funds on the leverage side that are bearish. So that piece is also coming out in the fourth quarter, and just go to etfguide.com. You can sign up for the snapshots. That's the key word you should look for, snapshots. So these are things that we do to help you stay informed and also stay on top of what's happening in the financial markets. 844-305-7800 is the number. Also, by way of reminder, if you ever missed this radio broadcast for whatever reason, do not panic. You can pick up our podcast. It's available at iTunes as well as SoundCloud Radio, Google Play. We're also on YouTube. Just search under the Index Investing Show. And you can also, of course, always find us just by going to indexshow.com. You don't have to download any apps or anything when you listen to the program at indexshow.com. You can listen right there in your browser. So taking a look at our Twitter feed, at Index Show, some things that I've been following and tweeting about. David Swensen, Yale University's, what is he, president, or I don't even know what his title is, but he oversees the endowment there at Yale University, but he's an absolute legend. And I've got an article link to what he's doing right now currently. He has invested some of Yale's portfolio, their endowment, in cryptocurrency-linked investments. So what does that tell you? I mean, if that's not a legitimization of cryptocurrencies, I don't know what is. Of course, we didn't really need David Swensen to legitimize cryptos. I think they were legitimized quite some time ago. But this is an area that's still emerging. It's rough waters. It's uncharted territory, and they're still trying to figure it out. And so cryptos, I think even especially after the crash of 2018, represent a very interesting opportunity for the non-core portion of your portfolio, or if you want to speculate, that should always be in the context of your non-core portfolio. So if you're going to do that, I think that's a fine place to do it, and I think it's a fine time to start nibbling. Also on the Twitter feed at Index Show, Banksy, one of my favorite artists, had a piece of art sold at auction, a $1.3 million, was it a drawing or was it a painting? Anyway, it was framed in a special frame, but hidden in that frame was a paper shredder. And so right after the auction of that particular piece, after it was sold at the auction market, I think it was over, it was actually $1.3 million US, just over £1 million British. So the piece self-destructed. It went to the shredder. I guess it had a device in the frame that was detonated, and right after the auction, the piece was shredded. And so this was one of Banksy's finest moments. He's had many fine moments, but I guess this was his way of getting back at the whole commercialization of art. I mean, I think it's a perfect response to art collectors and auctioneers who have hyper-commercialized fine art. And so Banksy pulling that trick, and now they're trying to figure out, well, is the piece worth more or less after the prank? So that's a pretty interesting thing. Also, I got another link on our feed at Twitter, again at Index Show, about how deficits in the U.S. have soared to $782 billion in 2018. $782 billion. That's a lot of bananas. And my point is this: if this is happening in a good economy, all these deficits, what's going to happen in a bad one? As we talked about on last week's show, and if you missed it, I encourage you to pick it up on our podcast. We archive every single show, but I did an interview with David McKnight, the author of that book called The Power of Zero, How to Get to the 0% Tax Bracket and Transform Your Retirement. One of the chief premises of McKnight's book, and I agree 1,000% with it, is that tax rates in the future will be substantially and permanently higher than they are today. And I think that's fundamentally different than what retirees in the past have faced. Retirees in the past have faced quite the opposite. They have faced a scenario of lower taxes or declining taxes. But this phase of lower taxes is over because of things like the deficit soaring and uncontrolled spending by the federal government, and of course out-of-control spending related to specifically not just debt, national debt, which is at $21 trillion, but then when you add in Medicare and Social Security and the obligations associated with those programs, you can really see a very ugly scenario of where the government has no choice but to raise taxes to pay for all of this. You can't print your way out of this problem. You certainly can't borrow your way out of this problem. And so that leaves you with two unappetizing choices. Either you reduce spending or you increase revenue, or some combination of the two. And as we discussed in that interview, it's going to be raising revenue. And you do that through raising taxes and increasing taxes. So we already know that tax rates are guaranteed to go higher in, when was it, 2026, I think that is. That's when this particular tax budget deal of 2017, that's when this sunsets. So we know that tax rates will become something else if Congress does nothing. But you can listen again to that interview, indexshow.com. That was a great interview, and it will help you also to reorganize and recalibrate your retirement plan taking that into account, using things like Roth IRA, Roth conversions, and the like. Also, I've got another tweet that I want to get to in the next segment. Elon Musk at Tesla basically saying, and he said a lot of crazy things, but in this case, saying that index funds and short sellers are co-conspirators. Oh boy, I want to attack that one. Stay with us. This is the Index Investing Show. I'll be right back.
The Index Investing Show with Ron DeLegge.
Are emerging markets on the move? For bold trades on emerging market stocks in either direction, trade EDC or EDZ. Direction's daily MSCI Emerging Markets Bull and Bear 3X shares. Don't miss your next big trade. Direction leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foreside Fund Services, LLC.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
Okay, on last week's program, we had some trivia. I asked the question, what was the highest income tax bracket in U.S. history? And we did not have an answer to that question I posed. I guess nobody knows the history of tax rates on listening to the program, but we do have Randall in San Francisco joining us, and he's going to take a shot at this, Randall. Randall, great to have you on the program.
Hi, Ron. Good morning. Thank you for taking my call. So the number that I've heard in the past that stuck in my mind was 94%.
Bingo, bingo, bingo. We have a winner. You're going to get a signed copy of The Power of Zero. Actually, I don't have a signed copy, but you'll get a copy. Dave did not provide me any signed copies, but I will get you a copy of that book. And that is exactly right. It's
scary.
Let me ask you this.
It's very scary.
It is. Now, let me ask you this as a bonus, Randall. And you sound like a very intellectually sharp individual. What?
I don't know about that. I don't know about that. I've been up all night.
Okay. Hopefully you've been drinking coffee. My question to you is this. So if 94% was the highest income tax bracket in U.S. history, how does that compare to the highest income tax bracket today? Is it high? Is it low? Give us some. What is the highest bracket right now? What would you take a guess at?
Well, today it's 37% federal.
There you go. That's exactly right. You get a bonus brownie for that question, and that's absolutely right. It's 37%. For taxable income over $600,000, married, filing jointly, that's taxed at a 37% rate. For singles, it's $500,000 or more. But you can see the whole point that we're trying to connect the dots and help you understand in terms of planning for retirement is tax rates today are, you could make an argument, are as low as they're ever going to be in history. And certainly we look at 94% versus where it's at today. I mean, we're at an ultimate low. It's never been this good for taxpayers. So stay on the line. We're going to go ahead.
So we've got 7+ years to kick butt and make some money.
Exactly right. And take advantage of low tax rates. The way we do that is by repositioning assets, especially those of us, before age 70 and a half. That's the time to be doing this. Once you hit age 70 and a half, We've got required minimum distributions coming out of our IRAs, and at that point, it's almost, I don't want to say too late, but it's very difficult to do any type of planning to take advantage of that. So those of us that are not yet 70 and a half, we really want to be looking at things like Roth IRA conversions and repositioning money into tax-free types of assets like Roth IRA, Roth 401k, and as David mentioned, some forms of properly structured life insurance may also be used. Of course, there's a lot of hang-ups there too. You have to qualify for that, so it may not even be an opportunity for those that can't qualify. But definitely not just looking at this and waiting and seeing what happens down the road, but actually taking concrete steps to lower your tax liabilities in the future. Randall, thank you for calling the program. Stay on the line. We're going to grab your address so that we can get you that book, The Power of Zero. Also, 94%, that was in the 40s. And that was on any income over $200,000 or more. If you made that amount of money, it was taxed at a federal rate of 94%. Now, that back then was a lot of money, $200,000. In today's dollars, that works out to about $3.2 million. Who do you think made that kind of money back in the 40s? Can you think of anybody famous that made that kind of money? I'm going to give you a hint. He was an actor and later became a politician. Yep, Ronald Reagan. He made that kind of money, and if you look at Ronald Reagan's biography, you'll notice that he only made 2 movies a year during those days. And one of the reasons that he did that was because he made about $100,000 a movie. And so he would make 2 movies and be done for the year. It didn't really make sense from a financial perspective for Ronald Reagan to make more than 2 movies a year, because every penny that he made beyond $200,000 was taxed at a federal rate of 94%. So you can kind of see and understand the impact that high taxes have on productivity, but also bringing this back to us today into our era is how it will impact us in retirement. And it's going to be a very, very ugly thing for people that don't properly plan and properly address this now, because of the fact that, for so many years, when I was first coming into the business of retirement planning and I was trained as a broker, we were always taught that, don't worry about people's income bracket in retirement. They're going to be in a lower bracket because they're going to be earning less money. Well, I can tell you that that's absolutely not true. It's absolutely not true today, and it won't be true in the future, because many of the tax breaks that people get that keep them or minimize their income are gone at retirement. Things like mortgage interest deduction, which is a big one. A lot of people heading into retirement have already paid their mortgages off or have very little interest payments on their mortgage. That's gone. Contributions to retirement plans is another big source of reducing income. Well, you're not contributing to 401k or IRAs in retirement. So that's gone. And then what about children? There's another great tax deduction. Well, hopefully your children are out of the house by the time you're retired. And even if they're not, well, they're probably past the age of where you can write them off as dependents. So that's a tax deduction that's gone. What about charitable contributions? Well, most people in retirement, instead of making financial or monetary contributions, they contribute their time. And so all of these wonderful tax deductions that people had during their working years usually vanish in retirement right when they need them the most. And that's one of the reasons why many people are shocked to find out that they're actually in a higher tax bracket in retirement. And especially if you've accumulated a substantial amount of money inside your 401k plan or 403b or 457 plan, by the time you hit 70 and a half, your required minimum distributions, just the amount that you take out of there, will easily push you into a higher tax bracket and cause all kinds of trouble, like having your Social Security taxed and so forth. So anyway, these are things that we want you to think about. 844-305-7800. These are things we want you not just to think about, but to plan for. Okay? Plan for, take concrete steps towards reducing your tax liabilities. Coming up next, we're going to talk about diffusing single stock risk. What does that mean? How to do that? We're going to discuss that on the show. I'm going to give you an example, a case study of one company, a former blue chip, that's General Electric, and we're going to give you a case study of how to diffuse single stock risk. Also, I want to talk about some tweets from Elon Musk. He's been sending out a lot of those. In this particular instance, he says that index funds are helping short sellers to take down stocks. I want to tackle that and get into that, so stay tuned for that in the next segment. 844-305-7800 is the number. @Index Show is my Twitter handle. Tweet us 24/7. Follow us. And we will be right back after this short break. Again, I'm Ronald Reagan. This is the Index Investing Show. Diffusing single stock risk coming up next.
Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, welcome back from the break. I want to get to this, our Twitter feed, @Index Show. A couple of other things on our podcast or on our Twitter feed. We've got a link to our podcast from last week, Beware of Higher Taxes, interview with David McKnight, Power of Zero. Also, before that, the previous program, we talked about gambling versus investing, the difference between the two, and rules for speculating, which gambling is, so that you don't blow yourself up. And it's okay to speculate. Got nothing wrong with speculation. I used to think that it was evil to speculate. But you see, the difference that thing that changed me was that I put it into context. I realized that, well, if you speculate with money you can afford to lose, then it's okay. But the context for that should be your non-core investment portfolio. That's the one place where it's okay to speculate. It's not okay to speculate with your core or foundation portion of your portfolio, and it's definitely not okay to speculate with your portfolio's margin of safety. That's the portion or bucket or container that's strictly reserved for capital protection. Principal protection, 100% liquidity, zero volatility. So it's all about context. Also, before that, we talked about, in a previous podcast, the myth that ETFs create day traders. There you go. There's more propaganda spewed by anti-ETF types, folks like John Bogle that say, oh, ETFs create day trading or encourage that. Well, listen to that particular episode because I absolutely annihilate that argument and destroy it and take it apart. So again, just listen at indexshow.com or iTunes. Also, on the Twitter feed, a toddler has shredded over $1,000 of his parents' money. I guess, I don't know how he did this, if he ripped it up or chewed on it. But what this shows is that children are self-taught experts at asset destruction. They're experts, they're self-taught, they do it very well. And I'm sure parents can attest to this. All of us as parents can attest to this. Getting back to Elon Musk, or as I like to call him, Elon Da Vinci at Tesla, he sent out a tweet saying that passive index funds constitute most of the market and that they encourage, most people don't realize that the shares held by these index funds are being lent to short sellers and that they encourage short selling, and that diminishes their true equity return. Well, there's so many things wrong about this. I love Elon even when he's completely wrong, but I don't really have the time to get into this today. I'm going to spend time on this next week, though. That'll be the headliner. Do index funds encourage short selling? Do they help short sellers? So we'll get into this a little bit more next week's program because we'll have some time. But it is true that index funds, index ETFs, will in fact lend out their shares, stocks, and they'll collect income on that. And so many times that those shares are being borrowed by short sellers. That could be hedge fund managers or institutions that want to take those shares and sell them short. The idea is to profit when the prices of those shares fall. But let me just say this. If Elon was as compulsively obsessed with delivering cars as he is with short sellers, then production hiccups at Tesla would not exist. If Elon's not careful, he's headed for a Howard Hughes-esque styled meltdown. Do you remember that movie Aviator? Howard could build airplanes, Howard could make movies, but he couldn't tie his own shoes. That's where he ended up. And Elon's paranoia is taking him to the same place. His paranoias about index funds aiding and abetting short sellers is exactly that. It's paranoia. And don't interpret or misinterpret what I'm saying here, because I am not anti-Tesla. I'm not anti-Elon. Quite the opposite. I love Elon da Vinci. I'm rooting for him because I like underdogs, and that's what Tesla is. But Elon's paranoia has gotten the best of him, and accusing index funds for helping short sellers of stock, because lending securities is incidental to an index fund and an ETF's business. It's not the primary business that they're engaged in. It's incidental. But it just shows you how far Elon's paranoias have traveled. Hyper-desperation, such a thing exists, and that's the zip code in which Elon is right now. Zip code paranoia. So let's talk about how to diffuse single stock risk. We could even include Tesla in that mix. But I want to use General Electric just because it has a longer trading history. If we look at the performance of General Electric over the past, let's say, 20 years, which is a long time, GE has declined 1.62%. So think about that. You've sat on GE for 20 years, and after 20 years, you have a return that's minus 1.5%. That's a pretty lousy return for sitting on a stock for 20 years. So the point is, how do we diffuse that single stock risk? Well, one way is to monitor your stocks versus their corresponding industry sector. And you can do this very easily with the Sector Spider ETFs, which offer you a clear picture of how that group of stocks is performing that corresponds with the individual stock that you may own. So in this case, General Electric, that's our case study, is a industrial conglomerate. And so we would compare that versus ticker symbol XLI, which tracks not just General Electric, but a group of peers involved in the same or similar businesses as General Electric. XLI tracks industrial stocks inside the S&P 500. And so by simply monitoring the performance of the individual stocks we own, we can begin to understand, well, is the performance good or is it bad? It's bad if that individual stock is not able to perform in line with its peer ETF, its sector ETF, or outperform. And in this case, we would have gotten those clues a long time ago. We wouldn't have to sit on GE for 20 years to finally realize, oh my gosh, it's been a horrible performer. We would have realized this years ago, that General Electric was underperforming on a consistent basis its sector peer ETF, that's ticker symbol XLI. So if we look at this over a 20-year period, as I said, GE down 1.5%. Meanwhile, XLI, which tracks industrial stocks as a group, ahead by almost 350%, which is a marvelous difference. And so there, we want you to diffuse that single stock risk by properly monitoring the performance. You can use this by, again, comparing your individual stocks versus their sector peers. The next strategy for diffusing single stock risk is to only hold individual stocks inside your non-core portfolio. And this is one of the things that I teach rather consistently. I yell about it a lot on the program, but I'm very adamant about it that if you're going to own individual stocks, that's okay, but they are considerably higher risk compared to broadly diversified assets like an index ETF, because things happen. Companies fail. Companies have CEOs, executive management that don't always deliver, and sometimes that can really come back to bite you. Now, sometimes it works out, sometimes it doesn't, but what we don't want to have happen is we don't want to have an individual stock that we bought completely go to zero. Sometimes it happens, and so if it does happen, we contain that risk by making sure that that holding is only inside our non-core portfolio. And then finally, the final way to diffuse single stock risk is to have an exit plan. Your investment time horizon cannot be forever, because in this life, we don't live forever. So that means you're going to have to, at some point, sell that stock. So have an exit plan and make sure you sell it at a good price, preferably when it's up. Tune in again next week. We'll be here. This has been the Index Investing Show.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.